I am aware of the plan to set up a structure which essentially, you could correct me if I'm wrong, takes fixed income activity away from the Nairobi Securities Exchange, and that is via the EABX platform, which you and I know is already recruiting a chief executive officer. What does this mean for the exchange? I shudder at the thought of NSE with only equities and not fixed income.
Yeah. So our recollection of the intentions of setting up another exchange, where I think was mooted some years back by a study done by one of the donor partners about a hybrid market in Kenya, saying that the Kenyan market could actually grow faster if it was a hybrid market, meaning that it had an exchange-traded debt market and an over-the-counter traded debt market. So that was the plan. We were initially involved in those conversations just to understand what the plan was, and maybe are there any areas that we could also contribute positively towards. The conversation then has been going on quietly, and now we're seeing an OTC bond exchange is being established. Now, we think that we've got a very good debt market in Kenya. We've built a very good market over the years. Today, we have got we could be the second highest, the second exchange in Africa with the highest turnover of sovereign debt paper. The largest exchange is JSE because they trade a lot of corporate debt. But when it comes to sovereign or government securities, we could be second in Africa. Now, with that, what have we done to just help our fixed income side market grow? One, we have fully automated this market. All securities are dematerialized, meaning that everything is being held in electronic form with the central bank. We have reduced the trading cycle from 3 days to a day. And in a day, we're doing almost 3 cycles of trades. You can buy and sell 3 times on the same day. Ease of settlement. We have worked with our partners, Refinitiv, to provide a platform for negotiating and agreeing on transactions through a call platform, which makes it very easy for trades to be confirmed securely through channels like that. Everything is happening extremely well, and hence we have a very good secondary market. And that just explains why even last year our turnovers went up 38% from 691 to 956 billion shillings. And we've helped the government raise money easily because of the ability to provide good exits. So we've done everything right. So we at the exchange did not see the need for a second exchange. I think we could just build on this, see how we can provide avenue for other players to come in. We have got a license that allows other players like banks to come in directly and connect and trade. And so in our view, having a second exchange, there's no merit initially. And the other argument we put across is that you'll have disparities in pricing. I mean, you've got 2 securities that might trade at different yields here. How do you merge those yields and come up with a standard platform? The NSE yield is what is used for pricing assets. Yeah. And hence, we thought that there's need for us to maintain our repository role for trade as a trade repository for purposes of that. But having said that, probably we think there were maybe overriding considerations and feeling that we should actually get a second exchange on board. So we know that there's going to be competition, but we have to maintain our leadership and maintain our focus in getting our market to remain where it is as now. So we welcome competition. The challenge is that we don't know. We still believe that there should be complementary roles that we have to work together. We've seen this model in Nigeria between the FMDQ and the Nigerian Stock Exchange, and we wait to see how that will evolve. But I can tell you from the very outset, as an NSE, we didn't see the merit in having a second exchange in a market that is still this young, and then create this two scenarios that might present other problems. We don't know.
Suppose the fixed income is actually hived off from the exchange. What would this mean for you from a revenue standpoint?
So right now, the fixed income contributes about 7% of our total revenue. It is significant for us because we have every plan. We had every plan to grow that revenue stream to take it to over 10% or close to 15% of total revenue. So we take it as a very important asset class for the exchange. But the reason why we even diversified our product offerings is because we wanted to de-risk our business from a concentration of two asset classes. So we've got equities and fixed income for many years. So the reason we have derivatives, ETFs, and all these other products is to then try and concentrate our revenue streams and have more other products contributing. So in the long run, if all our other products pick up, then I think we don't have a real risk because we have other revenue streams that can help support our business. But that possibly will take time. But in the immediate term, then we need to be very, very aware that we need to work hard to retain our market share because we'll sort of lose a bit of it to the market and find out we're just keeping our market share through this. The other focus for us is to go regional and to really bring in regional companies to come in on existing products and new products and more collaborations across the continent to also diversify our income stream. So we are now out of our what do you call it, comfort zone, and really we've been shaken out to go and do more to protect our business.
What would you say to the view that the necessity of this move is the fact that the NSE, from a turnover standpoint, has become so fixed income centric? There is need to carve it out and create ample space for dedicated focus on equities and how to grow this space.
I would not say that we are fixed income centric. I think we're just going through a normal market cycle where our fixed income markets are doing very, very well compared to our equity markets. Our primary objective is to help our equity market grow. That's really our bread and butter, and so we put all our energies there to achieve that. So I don't think I don't think the objective was to help NSE get out of any comfort per se. I think it's informed by the fact that I think when they look at other markets like South Africa, they find that the debt market is very big, and possibly the argument then was that just leaving it as an exchange alone, and the structure that we have where all trades are traded through broking houses and all this, that there was need for a separate market that trades differently. Maybe that will trigger the market to turn over better. So those are really the overlying objectives. I think the argument then was they feel that the investors need to trade directly more together. That's why they're creating a bilateral trading platform. They thought cost of trading is higher because you're going through brokers. They were saying that the market is not so visible from a depth perspective. I think those are the arguments. But we have solutions to all those concerns.